Hey everyone, it's Mike, and welcome to lesson number 4 of the Order Flows Delta Trading course, the Delta Trade Setups. This is the juicy part of the trading course where you'll learn how to analyze the Delta to find trades. Now, if you haven't already printed up this lesson, if you're just going to print up one lesson, I think this is the lesson you should print up. That way you can write your notes on the paper, or at least get a pad of paper out and write down some notes on this lesson. It's an important lesson, and I think this is the main lesson that people are interested in. And you want to know how to read the Delta to find trade setups. But before I begin, this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, so that out of the way. By now you should understand the importance of the different Delta numbers and the different types of chart types. So now we can move into the good part, putting it all together to find trade setups. Now you should understand the importance of just the Delta itself, the max Delta, the min Delta. You should understand the different types of charts you can look at. So once you start putting it all together, you can find trade setups. Now, I'm going to explain 7 order flow Delta trade setups that you can learn and apply them in your own trading. I'm not saying you have to apply every one or look for every one at every point in time. Find the ones that, for your markets, because I find in some markets, some of the setups may appear a little bit more than others, some not so much, but it depends on what market you're trading, what chart type, whether it's a range chart or a minute-based chart, and if it's a minute-based chart, how long a duration the chart is. So, there's different factors that go into it. So the setups I'm going to discuss in depth here are the Delta Surge, the Delta Divergence, the Delta Flip, Delta Transition, Delta Tails, Delta Bulges, and lastly the Delta Reversal. Now, the Delta Surge is a free indicator you can get on my website. If you run NinjaTrader, you could put it on there. The Divergence is programmed into the main order flows trader, but I'm going to explain what it is. So if you don't have my software, or if you're using a different software that doesn't necessarily have a divergence, or maybe it's not what I think a proper divergence, you can notice a difference. The Delta Flips and the Transition are 2 indicators that we've sold in the past, but I'm going to explain how to see them. Delta Tails is one that I made a video on about last month or so. It's quite a powerful signal that a lot of people have been sending me copies of their charts saying, hey, this is good stuff, program it in there, and it's actually probably going to be programmed. Delta Bulges is something I've just talked with other users about. I haven't really put it forward yet. It's a little bit subjective, but you'll understand it once you understand. And Delta Reversal, which is a great tool for, I'll say a great tool, a great setup if you can find them in the markets. It's a single bar trade setup. It's like a reversal bar. If you're looking at, say candlesticks or normal bar charts, and it's quite nice when they do appear. So one thing to keep in mind is, when you're trading, right, you need more than one trade setup to be successful. Okay, it doesn't mean you need like 1,000 trade setups, but you should have a handful of go-to trade setups, your bread and butter trade setups. And the point I'm trying to make is the reason you have to have more than one trade setup is because markets are either in trending periods or they're in consolidation periods. They're not always trending, they're not always consolidating. And if you have one setup that works good in a consolidating market, it's not going to work very well in a trending market, and you're going to suffer a lot of losses. And the opposite is true for a trending setup in a consolidating market. It's not going to work. So have different trade setups, which is essentially a trading plan for different market conditions. And more importantly, you have to find trade setups that fit your trading style, that's easy for you to see and comfortable for you to use in the sense of, risk to reward ratio. If you can't stomach a lot of risk, or you don't want a trade setup that has such a wide stop that every time you're into a trade and trade starts going against you, you want to vomit, that's not one that you want. Maybe you want something that's not as risky. So again, find the trade setups that work for you, that are easy for you to identify in the markets, because there's no point, right? There's no point in saying, here's a book on patterns or whatever, candlestick patterns. There's 500 in there. Use them all. You're not you can't memorize 500 different patterns unless you're Rain Man or something. But you're going to find the patterns that work for you, that you're comfortable with. And same thing is true with Delta. If you have a bunch of different trade setups that you can use, maybe you might want to modify one or two of them, to fit your style of trading. Go ahead. I'm not saying that these are trade setups that's set in stone. You can't modify them at all. No, of course not. I've taught trade setups to people, what to look for. Then I'm like, okay, go forth and make your money. Then, in 2 weeks we get back together and they tell me, you know what, I took this trade setup and I added this other little piece to it, and look at it now. And it's like, my mind is blown sometimes at the way people take an idea and run with it and adopt it to their trading style, and maybe make a minor change and it looks much better. So that's what trading is about, is finding what works for you, maybe taking something and adapting it to your trading style, or making a slight change that is going to help you become more successful in the markets. So the first one I'll talk about is Delta Surge. Okay, and Delta Surge occurs when the delta gets stronger in either a positive sense or a negative sense over several bars, 4 bars, and it indicates accumulation or distribution. I like to look for Delta Surge around market turning points or periods of consolidation. And actually, how the Delta Surge came about was, I trade a lot of palm oil in the past, and palm oil is traded in Bursa, Malaysia, and it's not a market like S&Ps. It's a market that you've got maybe about 20 main commercial traders in there, and you've got about 20% of the market is made up of local traders. But it's dominated by a lot of big traders that can move pretty good size. And when I used to look at a 5-minute chart, and sometimes it would just be bid offer, maybe a tick above the bid, tick below the bid, or a tick above the offer would trade, and it would just going sideways. But then I started noticing how delta would be expanding. It'd be getting greater in the sense over a couple bars, 2 bars, 3 bars, and then boom, the move, the market would explode in a direction. That's how the Delta Surge came about. So at least you get a little bit of backstory in there. And basically what was happening, I realized, was I didn't realize this till after I stopped working in the bank, because as at Cargill I traded a lot of palm oil. I was like, I was like the palm oil king there. But even when at JP Morgan we traded a lot of palm oil, and I didn't realize at a time, because I used to be privy to what I would look now on the delta for. I would be like piecing orders into the market, trying not to move the market, just buying all the available supply, accumulating a position. And then when that supply was no longer there to sell, just people working offers for me to buy, then boom, I just ramp up my buying, and the market, I could make the market go up 10, 20 ticks like that over the next 5-10 minutes. So Delta Surge is a specific pattern in the delta. It consists of 4 bars. Now for a Delta Surge buy, it starts with a negative delta in bar 1. Then bar 2 has positive delta. Bar 3 has positive delta that's greater than bar 2. And finally, bar 4 has a greater positive delta than bar 3. So, best way to analyze it is look at a chart. So, here, you can see how this market moves up, right? But if you notice the delta, minus 342 right here. And then 100. 356, 383. So what happened is you went from a negative delta to a positive delta. In this case, it's right on this swing low. Yeah, positive delta. The next bar, stronger positive delta than the previous bar. And then the last bar is stronger positive delta than the preceding bar. And the market makes the move up. This is the Delta Surge right here. Here it is again. This is when you're sort of coming out of a period of consolidation, right? You're in this range. You can see here. Here's your range. Minus 1295, 385 positive, plus 545, plus 1013. Market pops up, comes back, pulls back down within, tests that top of that range, and then moves back higher. You know, some people say, well, yeah, I could analyze, you know, here we got the breakout, we pull back here and rally. Well, what I'm saying is sometimes you don't get this pullback, you know, so people that are looking for the pullback to this resistance that's now support is not going to happen. And, you know, in the previous case, you didn't get necessarily the pullback you did right here, but oftentimes it's just a straight line. You know, it's just going to be a straight line, but you can know right in here that it's a legitimate breakout based on the delta, based on these deltas here, 385, 545, 1013. Here you go, minus 315 plus 160 plus 256 plus 986. Yeah, you just hit a low here, bounce up, come back down, then boom, start moving higher, 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 higher. So that's the delta surge buy. So basically what you're looking at is the negative delta, then a positive, greater positive, greater positive. Now originally, how I would look at it was, I didn't necessarily care if it was negative. I mean, in the sense of how strong a negative number was. What I was looking for in bar 3 was 50% greater than bar 2, and bar 4, 25% greater than bar 3. Now, someone I know that I trust did some research on it and said, you know, it actually doesn't really make that big a difference. You know, it's minimal. It's one of those things where it doesn't make a difference. Yes, it makes a difference, but not that much. So you don't necessarily have to. But that's how I used it in the original sense. I would look for 50% and then 25%, 50% greater and then 25% greater. Bar 3 over bar 2, 50% greater. Bar 4, 25% greater than bar 3. Now, in the purest sense, that's how I used it. But I'm saying, you know, if you don't want to use it in that sense, you don't have to. Just make sure its delta is expanding in a positive direction for a buy. Now, for a sell, it's the opposite. It starts with a positive delta in bar 1, then negative delta in bar 2, greater negative delta in bar 3 than bar 2, and finally in the last bar, bar 4, should have a greater negative delta than bar 3, the preceding bar. So this is how it looks. Delta surge sell. You have 735, 348, 1316, 1950. And you can see how it's expanding. Even the next couple bars is getting stronger, 2000, 3000. So positive bar, then negative delta, greater negative delta, even greater negative delta. And you can see how the market continues selling off. So that's the sell. Another example, 74, then minus 1324, minus 2030, minus 2384. And the market is selling off, keeps going on. You get the little pullback and then the push lower down into a new low down here. Again, 673, then minus 778, minus 1265, minus 1829. And what happens? Minus, and then even over the next several bars, it still continues in that trend. Minus 2442, minus 2691, minus 2724. As, you know, we sell off from, you know, what is that, 162.60 area all the way down to 162.40. This is in the buns. Again, delta surge. This is a 5-minute chart here. You can see it, positive 281, minus 63, minus 366, minus 946. And, you know, you're talking a move from, you know, the 163.10 area down into the 162.80 area, again, in the buns. And this is a move of just, you know, no pullback back up here to retrace this area up in here before the market sells off. It's just straight down. You know, those are the trades that you like to get as a trader. Now, personally, I find that delta surge works best when coming out of areas of sideways activity, especially if you're using a minute page chart. But again, you don't have to necessarily only look for it in sideways activities. You can look for it in breakouts as well, or at potential turning points, because they do sometimes happen. You know, say the market rallies, then you start seeing aggressive selling coming in, and aggressive sellers start piling into the market, and then delta surge kicks in at a high. Always think of the current market state. Take trades in context. Okay, I don't necessarily like to take delta surge buys after a big move up, or delta surge sells after a big move down. Now, for example, in this chart, if there was a delta surge down here, after we just had this big sell-off, I probably wouldn't be interested in it. What I'm more interested in is, in this case, we haven't had that big sell-off yet. So up here, I'm still interested in it because I know I got potential for a sell-off. But if I just experienced a big sell-off in the market and then there's a delta surge, I'd be kind of wary about it. I wouldn't be so interested in it. So delta divergence, this is the second one I want to talk about. A lot of software has a divergence, a lot of order flow software rather, has a delta divergence component fixed into it. And what delta divergence is, on the purest sense, is a sell will occur when there's a new or equal high is made with negative delta. Because when you make a new high, you expect to have positive delta. So when you're making a new high and you have negative delta, that's your divergence. A delta divergence buy occurs when there's a new or equal low with positive delta, right? Because you're at a low, you should be looking at negative delta. Because why are you at the low? Because they're selling. But if you have positive delta at a new or equal low, that's a sign of a divergence. Now, my software takes it a step further. One of the things that I had the programmer put in is, if I'm looking for a buy signal off a low, I want to have price action in the bar confirm it. I want to have a green candle, an up candle, a candle that closes higher than where it opened. Because having a new low with a down candle, a red candle, a bar that closes lower than where it opened, it's still negative in that sense. There's still selling going on, but now I know that there's buying coming in. The bar is closing positively. So that's the difference of the order flows trader software than a lot of the other software that has a divergence tool in there. They don't take into account that piece of price action when looking for a divergence. Like, for example, this low, right? If this was a red candle, even though you got the positive delta, I wouldn't be interested in it. Just like here, this bar it's a red candle, but you got positive delta, that would be a divergence if I didn't take into account the price action. But in this case, you got the price action here. So to me, this is a truer divergence than the previous one. So you can see the new equal low with positive delta. And here, you got positive delta, new equal low the first time, green candle, market rallies. Second time, you make a new low, positive delta, green candle, and the market rallies. Now, I'm not going to talk about these numbers here, these ratios. This is unique to my order flows trader software, that when combined with the divergence is a very powerful trading signal. But that's you're taught all about that when you get my software. This is a delta divergence sell. So you got your new equal high here with your red candle and the negative delta. And you can see how the market sells off. Here's another example. New or equal high, negative delta, red candle, the market sells off. So the thing is, what people sometimes don't realize is delta divergence is not necessarily restricted to highs of the day or lows of the day. You can use it if you're a swing trader, right? If you're looking for intermediate highs or lows, look for divergences at swing highs or lows. Now you'll have to use your brain to see them, because if you start programming them into a program, you might get quite a few of them. But if you're looking for a swing low like this one with positive delta, a green candle, it could give you some decent trading opportunities. Again, here's another one, positive delta, swing low, green candle, market goes higher. Here's some swing highs here. You have your recent high, come off, rally back up, negative delta with a red candle here, swing high, again a new equal high, negative delta, red candle, and the market sells off. So again, don't think you're restricted to only highs or lows of the day, but most software only looks at highs or lows of the day. But I'm saying you can look for them intraday, swing highs, swing lows, intermediate highs, intermediate lows. So this moves on to the next indicator, the delta flip. I used to call this the Voltos flip, but this is really the delta flip. And what it is actually quite unique to order flow because it's not something you're going to see on a regular bar chart, obviously. And the reason why I call it the flip is basically because, in the old days, but 20 years ago, there used to be this guy called the Flipper, Paul Rotter. And you could search him up on Google. There's a lot of interesting articles. Basically, he would work heavy bids or heavy offers in the market to spook the market. Then the market would move, then you'd cancel them, then you'd become a trader in the opposite direction. So he'd put heavy offers in the market to push it down, push it down, push it down. And then boom, all of a sudden he'd buy, big buy order. So he'd flip the market like that. And basically, if delta flip occurs when the market's experiencing a sharp change in perception of value and of direction, basically the market goes from all sellers to all buyers in 2 bars, or all buyers to all sellers also in a period of 2 bars. But I'm going to explain a little bit later how to look at it over 3 bars. Now, okay, so a delta flip buy occurs when one bar has 0 max delta and closes near its min delta value, and the next bar is the opposite. It has a 0 min delta and closes near its max delta value. And a delta flip sell occurs when the opposite is true. One bar has 0 min delta and closes near its max delta value, and then the next bar has 0 max delta and closes near its min delta value. This is why I talked about max and min delta in a previous lesson, so you can understand its importance and what it is, so that you can use it in this lesson to find the delta flip. And now when I say it has 0 max delta or 0 min delta, honestly, that's it in the strictest sense. It could have a very small delta like 5 or 8. If you're looking at, say, 0 max delta of, say, 5, but it has a very strong min delta of like 2,000. And I'm going to show you on some examples here what I mean by that. Again, this would be in its purest, strongest sense, but it doesn't have to be 0. I mean, it could be 1, it could be like 3 or something, but it's got to be very, very small, almost a single print, single digit. So let's take a look here. This is how it would look. So you got, this is a delta flip buy. So you got minus 649 is the final delta. You can see the max delta is 0. So at no point was the delta positive in the bar. The min delta is minus 654. Should make this a little bit bigger. Then in the next bar, it's flipped. It's 531 is the positive delta. Max delta is 533. The min delta is minus 14. So it's a small negative delta in the min delta here. And this is what it looks like. Basically, it went from all sellers to all buyers with very small counter trade against it in the bar. This is how it appears here for a sell. You got 116 final delta, 0 min delta, then minus 205, small max delta of 34. Your min delta was 273. So again, while I gave you these instructions, saying it has to be, it doesn't have to be 0. It can be a small number depending on the market that you're looking at. Because some markets, it's just such a huge amount of volume going through that you sometimes do get a little bit of counter trade early in the bar, that you get the instead of a 0, you get a small amount traded. But again, I like to see the zeros, but again, that doesn't say if it's not a 0, I'm not going to look for it. I actually, on the software, what we did in the programming, I was going to explain it here, is we took for the max delta, we took a volume threshold, saying it has to be a certain amount. So it could be anywhere between like 5% of the final delta, absolute delta number. So if it was a very small delta, like say 100, but it had a max delta of say 5, it would just fall in there. So there's different ways to look at it, but the concept is you're looking for the final delta of bar 1 to be somewhere near the min delta for a buy, and then in the next bar the final delta to be somewhere near the max delta, and in both cases for the opposite delta, the max delta in the bar 1 for the selling bar to be a small number, and in the buying bar where the final delta closes near the max delta to be a smaller number as well. Again, ideally you like it to be 0 in both cases, but I'm going to show you in a second, or not a second, in a minute, another way to look at it so that you can see things a little bit more clearer, because sometimes it's just, you sort of get this intervening bar in between. And this is another example here. Let's make this bigger. This is a buy, so you got minus 649 final delta. The min delta was minus 654, so it's you only difference of 5 contracts. Then here again, 531 versus 533, the max delta versus the final delta. And again, you do have a small delta number of 14, but again, I could I can take that. I could take that minus 14. I'm perfectly fine with that. Here you go. Again, just a little bit bigger. 1740 versus 1743 on the final delta and the max delta versus minus 9 on the min delta. And then minus 695 versus minus 728 with 1 as the max delta, and it sells off. Now here, this one is, this is a little bit interesting here. I'm going to talk about these sort of bars a bit later, but here, what I consider this one a flip in here, it's it's 418, but look at the max delta was 1457, so it's actually 1,000 contracts less. I mean, you got the min delta of 0, okay, but then here, this is how I like to see it. It's minus 1798 against minus 1890 with a 0. I wouldn't really consider this a flip in here, just because you lost 1,000 contracts. If this was 1418 as opposed to just 418, then yeah, I'd consider it a flip, but this I would not consider a flip. Now, with a delta flip, you can have an intervening bar, okay? And a bar, what I mean by intervening bar is a bar in between the two bars I would look at for the delta flip. So it's either going to be in between the negative bar and the positive bar, or the positive bar and the negative bar. And this is what I mean. So you can see here, minus 194, this first bar, 0 positive delta, 0 max delta. The min delta is minus 194. Then you got an intervening bar. Then the next bar, 133, final delta, max delta 133, and 0. This is what I call the intervening bar. I would just ignore it. Okay. Now, would I like to see it? To me, this would be like the I don't want to say ignore it. Rather, that's not a good term, but I'm willing to forgive this bar for being in the middle, because what I'm seeing in here is the market's selling off. You got the strong negative delta, then the market hits its low, sort of turns around a bit, then the aggressive buying appears in this bar right after that, and the market keeps going higher. Here would be on a sell. Okay, so you got 422 positive delta, max delta is 422, 0 min delta. Next bar, minus 402 against 409. I wouldn't necessarily consider that a flip at this point, because you got a positive delta of 71, which is kind of strong. I mean, some people say, well, that's a flip. Well, okay. But then definitely over the next bar, 781 against 809, minus 781 versus minus 809, and 0 max delta. So this bar in the middle, if you just sort of put your thumb over it, this is the bar where, we poked up, people started trading back and forth, and then the selling took over in the next bar, and then it sold off. And you can even see here in some of these other ones, like this one, if you were to expand it out a bit, minus 315 against 32, you could ignore this. I'll say ignore, but you sort of put your thumb over it. This is the bar where everyone is trading back and forth, and then 0 min delta in this next bar, 199 against 202. You would see it in a couple of these other bars, like this one, minus 649 against minus 644. Then this bar, I would take this as a flip, but if you're not convinced that this is a flip yet, after this next bar, 519 against 539 in here with 0 min delta, at this point I'd be convinced to get long. This is what I talk about. Sometimes people, they sit there and they look at something and say, I'm not convinced yet. Okay, well, now expand it over the next bar. Sometimes, in trading, it's, if you're not convinced that this is a flip, okay, fine, fair enough. But then continue to read the order flow and see what's going on. Look at the chart, because if you're not fully convinced yet, by the time this bar is done, you should be convinced that aggressive buying is taken over. and then the market is going to go higher. If you can even see it over the next several bars, here you got a 0 min delta, here you got a 0 min delta, 0 min deltas, 0 min delta. So you know aggressive buying is in control as this market is going back up. But the signs were here earlier to take the trade. I think that this would be a legitimate trade off this low. You also got a delta divergence going on there. But if you say, you know, I'm not convinced with this delta divergence, I'm not convinced that this is a flip, by the time you look at this bar and you think, oh my God, it's all positive delta, you know, 519 versus 539, 0 min delta, it's go time, you know, so you could catch a nice 20 tick winner right there. So that's the flip basically in a nutshell. And next one I want to talk about is the transition. I used to call this the Valtos transition. You know, one of the reasons why these were named after me is because people were taking my ideas and then calling them order flow algo extreme or order flow delta algo, you know, just nonsense stuff like that. And you know, basically they're trying to what do you call that, back program, you know, my ideas and push them off on their own. But you know, I'm explaining them here so you don't have to spend money on an indicator that does it. You can see it with your own eyes and make the decision yourself. So a delta transition occurs as the market is transitioning from supply to demand or demand to supply. And with the delta transition, you're analyzing the delta over several bars in context of the market. And when you reach a swing high or swing low or a high of the day or a low of the day, this is where you're going to be looking for shifts in supply and demand. You're not going to necessarily look for shifts in supply and demand as a market is in a trend, because it's defined already when you're in a trend. If you're in a trend up, it's a demand-driven market. If you're in a trend down, it's a supply-driven market. But when you get to a swing high or a high of the day, that's where you can transition in supply and demand. So for a sell, what you're looking for is a rising market, but the delta is getting weaker on the way up, and then the market turns and starts to sell off on negative delta numbers. For a buy, what you're looking for is a declining market, but the delta getting weaker on the way down, then the market turns and starts to rally on positive delta numbers. So let's take a look here. So you can see here, market's rallying, right? We're rallying. Look at these delta numbers. Plus 420, plus 274, plus 195. We're still going higher, but the delta is getting weaker. Then at your high, you got the negative delta, minus 20. Next bar, minus 280. And then the market just keeps selling off, selling off, selling off. This is crude oil. You know, so you could look at the delta coming up into this high, say, you know what, buying is getting weaker up here. We're seeing a shift now. There's not as much demand as there was earlier in the sense that it's not consistent, right? The demand, stuttering there, the demand isn't growing and growing as you're getting up to a high here. Then you're up here at your high, and what you're seeing is selling coming in. And then we sell off from, you know, the 85 area down into the 45 area. Okay, here. You got a high going up into the high plus 169, then minus 30, minus 170. Over here, you got minus 105, plus 105, plus 66, so it's getting weaker, then minus 347. Now, in this first example, right, you've got 5 bars. This example, you've got 3 bars. Now, when I first started using the transition, what I would look for is a big number, first bar, small number, the middle bar, and a big number in the opposite direction from the first bar in the third bar. Okay, sort of like here. Now, you know, people would start to confuse it and just look for flips, but really what you're looking for is demand in one direction, then sort of a mix, you know, sort of the market found a value area where it's trading back and forth, so you'd have a small delta, and then strong delta in the opposite direction in the third bar. So like it'd be 169.30, which I consider small, then a strong negative delta of minus 170. You know, 105, and a small delta 66, and then a strong negative delta of 347. You know, but when you can get more bars included, I think it just looks a little bit stronger optically. So what I'm looking for in a buy is a winding down of aggressive selling, a strong negative delta, then a bar of mixed delta, small delta, or positive or negative, doesn't matter, then a bar of strong aggressive buying, strong delta. So again, this is over several bars, but really you can sort of key in on the 3 bars here in the middle, minus 62, small delta positive 8, then strong positive delta 93. In this case, you can see how it's just winding down, minus 461, minus 255, minus 62, small positive 8, plus 93, plus 140. This chart is really almost, this is a low, right? Remember this chart here? It's almost the same. You see minus positive 420, plus 274, plus 195, and then small delta minus 20, minus 280. In this case, it's literally like the mirror opposite on the downside. You're looking for the selling getting weaker and the buying getting stronger. But what I'm saying is you can actually condense it down into 3 bars. Yeah, it's nice and beautiful when you got, over 5-6 bars, but you don't need to look over 5 or 6 bars. You can find it like this: minus 450, positive 11, and then plus 161. This is also the transition right here in a condensed form, especially when it's happening around a turning point, as it's happening right here. You got a swing low and you got the small delta, then it's sandwiched in between the strong negative delta and a strong positive delta for a buy. Now for a sell, it would be sandwiched between a strong positive delta and a strong negative delta, the opposite of this. Here, minus 329, minus 283, minus 154, plus 74, plus 174. And you see the market is going back up. Some people say, well, plus 74, that's not such a small number. Okay, well, I could take it here. I know this I wouldn't consider necessarily a swing low. It's minus 110 for plus 182. The reason why I like this one, I do like this other one, but I think this one could have got you into the trade, is because you're seeing the delta winding down, minus 329, minus 283, plus 54, then it flips positive 74, plus 174. This would just be, icing on the cake, confirming that, yeah, you're in the right direction in the move. All right, so delta tails. Now, delta tails is something that you'd have to look at a delta footprint chart. And, I talked about that in an earlier lesson, the delta footprint chart. And a delta tail is going to appear when on a sell, when there's a positive delta at the top of the down bar and the rest of the bar is all negative delta, or for a buy when there's negative delta at the bottom of a bar with the rest of the bar exhibiting positive delta. So let's start by looking at buys. So a buying tail is occurred when there's all positive delta on the way up of a bar, except for the bottom of the bar where there was negative selling. So, maybe early in the bar exhibited more negative selling. Then the market snapped back and rallied, all positive buying on the way back up. Okay. Now a selling tail is the opposite, right? When you have all negative delta in the bar, but the top bar, the very top price level, there was positive delta. And this is how it looks on the chart. So this is, again, this is a delta footprint chart. Your software should allow you to do it. If it doesn't, I suggest you pick up mine. It's easier for that. But again, I'm not making this course about my software, but I use my software because that's what I use, and many traders. There's probably about 500 or 600 traders out there that are using the software that will find the value in this delta tails. So you can see minus 17. They're just all aggressive buying. These are all positive deltas. Here's a sell. You got the tail up at the top, the 92, positive delta, then all selling in here on the way down. You see how the market goes down. Now depending on the type of bar you're using, say this is an 8 range chart, okay? And people say, well, you know what, I'm using an 8 range chart, so can I take, like in this case, would this be a buy? I got 2 tails down here, minus 12, minus 50, but the bar is quite long. That's a personal decision you have to make. Do the studies yourself. Me, I like the one. I like the one price level, but I know some people are using 2 price levels if they're using a long bar, like in this case an 8 range bar. If you're using a 4 range bar, you wouldn't use 2 price levels, you would just stick with the one. But I could understand using an 8 range or a 10 range bar and accepting the other, another level of 2 in here. But it works perfectly fine with long bars with just 1 price level. But I know some people want more trading opportunities, so they're willing to take a trade like this that has 2 price levels. This is how it looks on, this is wheat, and you see it. on a 4 range chart. So you can see a tail here, a tail here, a sell and a buy. Now again, you know, for a 4 range chart, would I be willing to take this, this one right here, this green bar with the 2 price levels? No, because it's already over almost half the bar. So there's only 5 price levels in the bar. This is actually another tail here. I didn't circle it, but this is one here. Okay, what is this? Buns. A sell, a buy, a buy, a sell, a buy. You see how the market is just following it. You know, it's on its way down, pops up to a sell, sells off, rallies off this buy up here. This is one over here on the corner. I didn't circle it because I don't remember what happened on the chart. Here's a couple sells bunched together, 1 and 2. And then another grouping here, 1 and 2. But again, you know, would I be taking, you know, there's one here in the middle also, which I didn't circle. Would I take like this bar over here with the 9 and the 1422, and then the 3 price levels? No, I really wouldn't be interested on a 4 range chart, just because there's just, you know, to me that's not a tail. Okay, I'll just leave it at that. This is a 5-minute chart. This is the E-minis 5-minute chart. You know, before I was showing you range-based charts, but now you can see it on minute-based charts. I think on minute-based charts it does appear, but again, if you're looking at a 1-minute chart, you might not get a lot of price levels, so it's going to be kind of difficult to really make a good trading decision. This is a 5-minute chart, and you can see in some of these bars, it's basically essentially a 4 range chart. This one's got 4 price levels. This one's got 4 price levels. I wouldn't consider this a sell as the doji bar. With order flow analysis, I like doji bars. I kind of treat as neutral in the sense that in order flow, I don't read too much into it one way or the other. I like green bars for buys, you know, up bars for buys, red bars for sells. So here, you know, again, you know, these two right here, okay, this is a 5-minute chart. Now, would you consider these tails? You know, then even at this point here, right, again, I just want to show you this. That's why I highlighted it. Is, you know, you only got 3 price levels. Is that a tail? Technically, yes. Is this one with 4 price levels a tail? Yes. Is this one with 4 price levels a tail? Yes. But 4 price levels to me isn't enough movement, right? I prefer, you know, at least 5 price levels in a bar. That's why I don't look at three range bars, or, you know, I do look at 4 range bars, but I sort of have a minimum cutoff, and it's 4 price levels in a bar. Is anything below that, to me, that's not enough movement in a bar to really give me a good sense of direction. Whereas then up here at the top, you know, you've got the tail, and you got 1, 2, 3, 4, 5 price levels. Those bars got 6 price levels. That's enough for me. Whereas when you're dealing in small bars, which is just basically trading the bid and the offer, more or less, or a tick above or a tick below, that's not enough price activity for me to really make a great trading decision on. You know, because then otherwise you're going to come into a bar like this one here, minus 425 against 437, and say, well, you got a tail, it's a buying tail. No, it's a selling tail. You know, and you're just going to scratch your head thinking, WTF, what's going on in this market? You know, that's why I like to have at least at a minimum, I look at a 4 range chart or 5, you know, 4 price levels. I think is just, you know, it's basically the bid offer and a tick below or a tick above. With 5 price levels, it's not just the bid offer and a tick below or a tick above. It's an additional tick above or an additional tick below that gives you the good price movement. All right, so delta bulges. You know, it's if you grew up in the 70s, you know, I was born in '69, but I remember there was the skit on Saturday Night Live, but it wasn't so political now, you know, but Steve Martin and Dan Aykroyd did this thing of 2 immigrants from like Russia or Ukraine or something like that, and they talk about their bulges in their pants when they're trying to pick up women. It's actually kind of funny, but now people say that's not politically correct. But go on YouTube, look up Steve Martin, Dan Aykroyd, Saturday Night Live, and you'll find them, and you'll see, and you'll understand what I'm talking about bulges. And the same thing is occurring in the market. And it occurs, again, this is on a delta footprint chart. When there's a big delta volume at a price, or bunched in a few prices in a bar. It doesn't necessarily have to be in one price level. It could be, spread out over 2 or 3 bars, or 2 or 3 price levels in that bar. And if you've been a part of my inner circle, you'll understand I've talked about oversized imbalances in the past. And oftentimes this will show up in an imbalance, but it doesn't have to. And what it indicates is support or resistance. Now again, you have to take it in context of the market. Alright, so with delta bulges, you need to use a delta footprint chart. And a buying bulge appears when there's greater than average, like 2 or 3 times, even more greater negative delta near the bottom of an up bar. Or a selling bulge will appear when there's greater than average positive delta near the top of a down bar. Now bear in mind, some days this may not appear at all. Okay, so don't try to read into the market something that isn't there. Don't say, well, this looks kind of big. It's not normally a number I'd take, but there hasn't been any today, so I'm going to take it. And what it looks like is this. So you can see here, these are the red bars. You have delta bulges up here, 852 at the top of the bar, 607 up here. And why is it considered a bulge? Is because normally the delta is anywhere between 60 and 100, we'll call it 150. And again, while I'd say take it in context, right? For a sell, it's got to be up near the top of the bar, not somewhere down here on the downside. It's got to be positive delta. It's got to be a positive delta in the bar. And what's happening is the market's going up, but it's met with resistance. That's what I talk about when I say it's resistance in a bar. Support is down here, right? You got minus 1371, minus 888. This is what I talk about. So it doesn't have to necessarily be one level. I would not consider this bar over here, this red bar with minus 1204, minus 1405, minus 1735 bulges. Because for a red bar, I'd be looking for it at the top, like up here. Positive 1181, positive 1068. On the green bar, it's going to be supportive on the left-hand side, whereas on a red bar, it's going to be resistance up here. Because you have to think about what's happening in the market. The reason why this is resistance is because people are working offers up here. You have aggressive buyers buying these offers, 1181, 1086. Then the market sells off. It meets a support area down here, 1371, 888. Okay, this is as it hits the support, the market rallies, right? When you run into the big volumes like down here, minus 1,000, minus 1048, the market ate through those levels, right? That's what it's supposed to do. It's not support. The market didn't rally up off those levels. It's rallying up off of here, right? Just as up here, right? You got 1856 on the top of this green bar, and we went through that. Then it's showing as support up here, plus 1181, plus 1066. This is your resistance up here, and the market sells off. Now, it can appear in a move as the market tries to pull back or retrace a move. And what do I mean by that is, you see here, market hits a swing high, you got a bulge up here, 1133. Starts selling off, makes a little bit of a pullback up here, 1389, and continues on down. Over here, 633, now this is what I talk about, by understanding what your volume is. Would I consider 633 or even over here 782 a bulge? Well, I like I said, it's normally these bars you're looking at anywhere between 100 and 250. These are, is it 2 times greater? Yeah, but when it's definitely above 1,000, to me, like I said, this is an 8 range E-mini chart. When it's definitely above 1,000, that's a lot stronger. In the sense that it's a lot clearer. Can you take these? Yeah, maybe you can, but I said I like it to be a lot stronger. Minimum 2 to 3, but preferably more. Here it is in the move. Now this is a crude oil chart. Okay, so normally on a crude oil chart, I'm looking at anywhere between 25 to 60. So if I'm looking at something in the 200s, to me that would be a bulge. All right, so you see 245, then here, so you got some resistance here, but it's met with support, 247, 235. And the market makes its move back up. Where does it make its move back up to? All the way up here. You got this little bit of I'd hardly call this a pullback, but in the next bar, it's appearing here. This is where you'd like to see it. If it was on the right-hand side of a green bar, I'm not too interested in it. Here, minus 198, and this one, sorry, positive 198, positive 276. I should have also drawn the arrows there. To me, this is a bulge. 198, yeah, that would be borderline. But then when I see this one in here, again, it's back to support. You know, your previous resistance. I should copy that here for you, just so you know, you're not thinking that I'm scamming you. But to me, yeah, I would take this one as definitely a bulge. But then when it comes back up just above there, now this resistance selling has become supportive buying, which is a very strong signal. And you can see even up here, you're seeing some more bulges up in here, minus 314, minus 216. Up in here, 698. You know, where do you see volume like that? Anywhere up in here. You know, or anywhere on this move. You know, on supportive buying, you know, 132, 125, you know, 278. But then up here, you got resistance selling up here, 698. Market reacts to it. We sell off, rally back up right up to that level, then continue on back down. So that's what the delta bulge looks like. So again, you know, try and look for a big number, right? Don't just take a number that is slightly bigger than the average numbers that you're normally looking for. Take something that's very clear and stands out. Now, delta reversal. This is the last one I'm going to talk about. Delta reversal is a single bar setup, and it's going to identify a swing high or swing low. It's the internal delta changes from strong in one direction to closing strong in the opposite direction. It's a single bar setup. Remember that. A delta reversal buy exhibits strong negative delta early in the bar formation, but finishes with a strong positive delta. A delta reversal sell exhibits strong positive delta early, but finishes with strong negative delta. And how does it look? It looks like this. See this bar where the box is here. So final delta, headline number 2359, max delta 2359, min delta minus 1766. So early in this bar, very strong negative delta. We're on a move lower. We're going down, down, down. Early in this bar, it's all sellers, minus 1766. Something happened in here where traders said, hey, you know what? This is a cheap price. And they start buying. They buy, buy, buy. Market changes internally, and it closes very strong positive delta. It went from a very strong negative delta to a strong positive delta. And you see how the market rallied from 28.97 all the way up to 29.04. Here again, minus, this is bonds this time. Swing low, or actually low of the day, you got a divergence. But look at the internals, very strong negative delta, minus 1,000. Okay, market's selling off. You're at your low. You're looking at, okay, I'm at my low. We're probably going lower. I see 1,000 negative delta. But then what happens? Buyers step in. Positive delta of 1156, or max delta is 1156 as well. Buyers are now in control of this market, and the market makes a beautiful rally up. Now, the key to a delta reversal is both the max delta and the min delta should be strong. Okay. Now, it's easy to take one strong delta, either a positive delta, and one not so strong, and think it's, you know, a reversal. It really needs to be both. And what do I mean by that is like this. You know, can you take this? Well, you got to, would you consider, right, this is bonds, you know, you have to consider, you got a negative delta of 682. Okay, is that a strong negative delta? That's actually about an average negative delta. I mean, yeah, this trade worked out nicely if you took it. But for me, I would not consider 682 strong. If it was 1,682, I'd consider it a strong negative delta. The positive delta, the max delta, and the final delta, that's what I like to see. It's a nice strong, you know, over 1,000 in a 4-range bond chart, I would consider strong. Because otherwise, you're going to start reading into it. You're going to start seeing it all the time then when it's really not necessarily there. But again, that's a decision you have to make. For example, here, right, this green circle, it's 396 versus 396 delta and max delta. The min delta minus 246. You know, is this strong? You know, these are kind of strong, honestly. 246, you know, I would like it to be, you know, probably above 300 rather than 246. Over here, would I consider this strong? Not really, even though this one did sell off for the next 2 bars. What I would consider strong for this market, this is crude oil, right? This is an 8-range chart, is how I would consider it strong is I would look, well, I would know because I keep track of this stuff, what is a strong number. It's definitely over, 350 I'd consider strong. Like here's 700, here's 390. I consider that strong. Even here, would you consider this would probably be a flip. I'd probably see this as a flip. Short-lived though, but then it came back with another flip in here as the market went back up. Again, it's all about taking what you're seeing in the market. Here's positive delta 499, 390, 749, 396. But this one's just a shade too light, and this one's definitely too light. Even though it's a trend, even though it's a reversal, it's just too light. It's 139 and 112, whereas that's about your average numbers. It's probably even this one's below average. This one, the positive delta is above average, but I'd consider this, the min delta, just outside of the range of negative delta that I'd like to see. Like even here, you got 300, 356, 246, and it's just a shade too light. That's why I say, understand the market you're trading and make sure it's a strong enough number. Again, borderline, some people say, yeah, it happened here. Well, honestly, I sort of take this as a bit borderline. I mean, you do have a surge going on right here, and then a flip over here, 587 against 0, and then 304 against 308. Even here, 401, positive, no negative. But this one, I would consider this one very borderline. 149, 148, I wouldn't consider that strong. 211, I wouldn't consider that strong. I'd consider these about average numbers that I'm looking at on this 8-range crude chart. Comparing it to regular, these other numbers, 253, 278, this is definitely nothing strong. Even, here at 221, this is definitely not stronger. So, understand the market that you're trading and make sure the number's strong. It's got to be a big change, like you saw here, 1,000, either over here, right? 1,700 versus 2,300. Now, the goal of trading is developing a method of trading that's going to be consistent with how you trade. Now, I presented actually 7. Oh, I got 6 there. But there's actually 7 different order flow trade setups that you can use, right? And my goal is to get you thinking to find your own ways of using delta by either using these setups or modifying them for your own trading. As a trader, you have to separate yourself from the rest of the crowd. You can't be doing what everyone else is doing and expecting to be successful. Because if everyone's doing the same thing, then the markets aren't going to move. No one's going to be successful. Majority of traders lose. So you have to find a way that's going to separate yourself from the rest of the losers out there. And in trading, the goal basically is to take money out of the other person's account, legally by taking the right trades, going, trading against them. That's the whole point that people trade. They don't trade to feed the world. They don't trade to, cut carbon emissions. No, they trade to make money. That's the whole point of trading. So you always got to be looking at ways of viewing the market that other people aren't viewing the market, that makes sense, that have logic and reason behind it. Not like, oh, because we hit this imaginary line that we got to come off. No, when you're seeing the shifts in buying and selling going on in the bar, you can make a logical trading decision based on logic, right? Based on what you're seeing in the buying and the selling. Not that, oh, we hit this retracement at a certain level, so I got to be buying. No, you're saying, oh, I see we had aggressive sellers earlier in this bar. Now aggressive buyers are dominating this bar. It's probably in my best interest to get long. So that's the end of lesson 4. In lesson 5, I'm going to recap the different pieces of delta and how you can start using it in your trading. I'm going to go over a bunch of exercises, a bunch of charts where I'm going to give you a chance to look at the chart, get your thoughts together, see what you see in the chart. Then I'm going to explain what I see in the chart, and you can compare with what you thought you saw versus what I saw in the chart. So that's going to help you, grow as a trader to understand delta. So thanks everyone, and I'll see you on the next lesson. Bye-bye.